All right, hello there. Welcome everybody to this week's edition of Selfwealth Live, the technical analysis edition. My name's Roger, and I'm from Selfwealth. And to my left is Jason McIntosh, and he is from Motion Trader. I want to welcome everyone on the other side of the line today. We've got a big show coming up. Once again, the market seems to be moving. Gold has hit an all-time high, so I'm sure we're going to get a few questions around these tickers today, Jace. But how are you?
Hey Rog, I am good, all good. First week back from the Christmas break, and looking forward to talking about some charts this week.
Yeah, well, exactly. Second week back for us, but we also had a long weekend. So I hope everyone had a great Australia Day long weekend, and not suffering too much from the heat. Thank God for air conditioning, and God bless. I'm going to make a political statement. God bless all the firefighters that are out there doing it tough out there, and the people that are doing it tough as well. Right. So, all right, let's get on to. The show. Now, I've worked out. I know based on feedback from last year, and I could never really work it out until for some reason I've worked it out today, is that I can see people are putting in messages before we go live, Jay. So I can see some of these messages now, and I apologise for missing them in the past with the software we're using. We couldn't see them in the past, but now I've worked out that I can see them on my mobile phone, Jay. So we'll get on to some of these questions that were put in before the show starts, just to give everyone a fair go as best as we can. But other than that, Jace, once again, welcome everyone coming along. If you're a beginner here with us, what we do is we go through the top three markets that we have at Selfwealth, that we offer at Selfwealth without trade. That's the Australian market, the US market, and the Hong Kong market. And what we do is we look at the price charts or the structure, based on on how the charts look. We don't really do anything around fundamental analysis. All right? So if you're asking us what's happening in the world or why this is happening, well, that's not our forte. There's plenty of news announcements around what's happening in the world to cause this. What we do is we look at price action and the way the charts look effectively. All right. The other thing we do is we go through any general questions. So we've got a general question around technical indicators today, Jace, which will be a bit of a recap for some of the advanced in here, but it's always good to recap over some concepts, right? And then we'll go through one of your tickers, and hopefully be done within the hour on the show, right? So, but I'm looking forward to it, Jace. Let's get having a look at that disclaimer, if that's okay.
Okay, so of course, everything we do today, general commentary only, no personal advice in any of this. And I'll quickly put up the disclaimer that we do each week, and this just goes through that. I'm not part of the Selfwealth Safe team. My business, as Rog noted, is Motion Trader, so you'll see my details at the top, licensing, etc. And beneath there is the Selfwealth disclaimer, licensing, general commentary, all of that is all in that little slide there.
Thank you, Jace. All right, so now that everyone can hear and everyone's going well, it looks like, let's start with the Australian market. It does look like they're starting to nudge up again, these markets.
Yeah, so let's go over and start off with our ASX 200 chart. And last week, we pulled back towards the moving averages. And since then, just over the last couple of trading days, the ASX 200 has now had a strong rebound off the moving averages. And it's trading around a 3-month high. And it's interesting to look at the pattern of the pullbacks and rallies since this October low. And a good way of doing that is by using some Fibonacci retracements. So Fibonacci retracements, if you're not familiar with them, just Google them and you can read about them. And but they're an interesting way to get proportion to pullbacks. And so I can actually use an indicator to demonstrate that here. So let's use this October low to start, and we'll go to the first rally high. You can see this green shaded area. Notice how the pullback came back into the Fibonacci region. And then we've got our second rally from mid-December, and then the subsequent pullback again into that Fibonacci region. And then we've had the most recent rally, which just last week came back into that Fibonacci region, coincided with the moving averages, and now we've had the rally off there. So it's interesting. We've got this stepping pattern where we get a strong rally, we get a consolidation, a strong rally, a consolidation, strong rally, consolidation. It's So yeah, as I say, it's that stepping pattern higher. So it's showing that the dips are being bought and the momentum is to the upside. And I think now let me just take those green shaded areas off. Now I think with the ASX 200 above the moving averages, I think if the ASX 200 can continue to establish itself above the moving averages, well then the odds continue to favour the upside. Also note that the moving averages are now turning higher after a period where they were pulling back, going sideways, and now starting to lift upwards again. And that, I think that really tells us the underlying structure here remains bullish, and I think we should continue to position our portfolios accordingly. What has been interesting is that the two-speed nature of this ASX 200. So, as I say, this underlying trend remains up, but the ASX 200, it's still trading around. If you look where it is now, it's still trading around where it was in, say, mid August. So that's nearly 5 months ago. So on the surface, it looks like maybe there hasn't been a great deal going on in the ASX 200 over the last 5 months, but that's actually not the case. So in one corner, we've got the financials, the ASX 200 financials index. And this has really been struggling of late, and it still remains technically vulnerable because it's trading below declining moving averages. This isn't a strong structure for the financials. Nothing new there. We've discussed this in the past, but this is one of the reasons the ASX 200 looks like it hasn't done a great deal over the last 5 months. But then this weakness we've had in the financials has been countered by the strength in the mining sector, and this shows up in the ASX 200's materials index. So you can see this has been anything but a dull market over the last 5 months, and this is something we've talked a lot about over in recent times. I think this is, Roger, I think this is a great example of one of the benefits of actively managing a portfolio, and that is that we can use. Like, there's all sorts of ways you can actively manage a portfolio, but what we talk about is using momentum to focus on what's working and then avoiding what's not. So at this point, what's working has been materials, has been mining stocks. What's not has been financials and banks. So I think rather than just owning the index, which has not done a great deal since August, an option for people is to consider cherry picking. Cherry picking what appears to be the best opportunities by using these momentum strategies we talk about. And in this case, some of the best buys have been in this materials or mining sector. There's one more chart I want to show you for the local market, and that is the equal weight, the ASX 200 on an equal weight basis. And I think this is always interesting. It's one of the most important charts, I think, to take in. Look what's happening in the equal weight. It's hitting a new all-time high. It's hitting a new all-time high right here today. And that contrasts that with the ASX 200. Just quickly jumping back to the ASX 200, well, it still remains about 2% below its October high. Coming back to the equal weight, you see the equal weight. It's nicely cleared its October high. So what's important about this, what this is telling us is, well, what it's doing, it's removing the distortion caused by a few big cap stocks. So notably CBA, which has been struggling of late, and CBA is also currently the largest stock, I believe. And I think the equal weight's giving us a better picture of what the top 200 stocks, what their underlying strength or weakness happens to be. In this case, I think it's underlying strength. In my mind, at least, there's no question this remains a bullish trend, and we've been consistently saying that since way back in May last year. This has been a bullish trend the whole way through, and I think with the moving averages rising, with price being above the moving averages, and of course the index, the equal weight hitting a new all-time high, well, none of these are bearish signals. So we hear in the media people saying things are overpriced and so on and whatnot. But as it stands, we don't have any bearish signals. We've got a bullish trend. Not to say the trend can't change, but at this point, it's a bullish trend. So I remain long stocks. I continue to look for opportunities. And as always, I've got my motion trader trailing stops to protect capital should the situation change.
Yeah, I really like the point you bring up, Jason, about just having that little bit of extra education around reading these charts can put you into this position where you're not just sitting and waiting and looking at your portfolio with a few ETFs in it, not going anywhere, but being able to select some certain stocks or looking at another charts, let's say the mining and the mining sector and the commodities sector, these sectors that are doing really well versus these big caps that everyone knows about and just are going the other way, right? Having this little bit of extra education can really help towards adding, if you're interested in knowing about the fundamentals and why everything's happening, that's fantastic. But the other thing that I've taken out of this, Jace, is that you're not making, once again, any predictions of what's going to happen. One thing that was taught to me when I was first started learning about this is, once again, trade what you see and not what you think. And this keeps on coming back to me all the time. When I see all these predictions from market analysts of what's going to happen this year, no one's ever going to know ultimately. Yes, they might be right, they might be wrong, who knows? But what we're doing is just setting the scene and trying to position our portfolio to be in that segment that's making us money. So do you want to know what's happening in the news, or do you want to learn how to make money, right? So do you want to know how to grow your portfolio? That to me is a really important facet of what has come up, what you just said there, Jace. So.
Yeah, look, predictions are interesting. They get clicks, and they can sound, they can draw you in with a good story. But as you say, the fact is that none of us can actually see the future. So rather than try and predict what we clearly don't know, it's about using rules, using process, and responding to what is happening, and just looking for what's working, what's above rising moving averages, and going with trends rather than trying to foresee their end or a change in trend. Just like, well, yeah, sure, trends will end, trends will change, but we don't know when. So it's a case of find the path of least resistance, invest along the path of least resistance, and manage risk. I think that's in an uncertain environment. I think that's the way to play it. Of course, nothing wrong with knowing your fundamentals. Fundamentals ultimately drive things, but it's the momentum which we can see and which is, I think, more straightforward to understand a lot of the time. And nothing wrong with ETFs either. I've got plenty of ETFs, and actively managing a portfolio is not going to be for everyone. But for those who are interested in it, it can be like ETFs can be a great long-term play. You set and forget your longer-term index ETFs perhaps, but then you can actively manage another portion of the portfolio where you do focus in on the areas of strength and avoid areas of weakness. And it can be an interesting way to get some outperformance. It's also fascinating for those who like their stocks and like seeing all the companies and the different names of companies they've never heard of before. We can identify all that with momentum. So yeah, find it fascinating, Rog.
Yeah, I totally agree. Once again, there is nothing wrong with ETFs when I say anything like that. Actually, in one of our previous series last year, we talked about having that core portfolio and satellite portfolio, which us as active investors would be looking at putting these stocks that we individually pick in more of a satellite style portfolio, right? And then investing in your core. So if you want to have a look at that, that's in our previous series that I've done with Gary Stone, right? So last year, have a look at that one there. But let's get on to the US market, please, Jace.
Okay, so S&P 500. Well, you wouldn't know it by looking at this chart, but there's actually quite a bit going on in the US market at the moment. Just starting with the S&P 500 first, the underlying trend. Well, the underlying trend is still up. You can look at these moving averages. You've got the 50-day, got the 50-day, got the 100-day moving averages. Both continue to move higher, and price is above those moving averages. So that's what we call a bullish structure. That's been the case since back in May last year. So we've had a long stretch of months with bullish price structure. But what is lacking at the moment? What's lacking at the moment is near-term momentum. The S&P 500 really hasn't been able to make any headway for the last 3 months, and you can just sort of like see this period here. It's been sideways with an upward bias, but it's not made a lot of lot of headway. But just like in the ASX 200, there's a lot going on below the surface. So firstly, let's look at the equal weight. So the S&P 500 on an equal weighted basis. And again, you can see, like the ASX 200, the equal weight is doing well. It's making new highs. It hit an all-time high on Thursday, and it continues to trend higher. Again, we've got those rising moving averages. Prices are nicely above them. So the equal weight's telling us a very different story to the S&P 500. While the S&P 500 is stuck around levels from late October, the equal weight, well, it's been extending higher. So what we take from this is that it's basically a broad-based advance in stocks, and there's increasing participation. And this we can tell this because the equal weight is doing well. For the equal weight to rise, where each stock is weighted equally, it's for that to rise, you've got to have a lot of stocks participating. It can't be pulled higher by one super stock, as the S&P 500 potentially could. So we've got that participation coming through, which is good. And as we've discussed often in the past, strong participation is a sign of a healthy market. In the ASX 200, we discussed a two-speed market between financials and miners. In the S&P 500, it's kind of two-speed between tech and industrial. That's largely, and they're the two sectors that are largely countering one another. So, firstly, looking at the this is an ETF for the Magnificent Seven, the top, those big seven stocks: Nvidia, Apple, Microsoft, Amazon, and the like. They're all within this ETF, and this really hasn't done. The Magnificent Seven hasn't really done a great deal since late October. It remains in an uptrend. You can see it's still got these moving averages, which are generally pushing higher. The 50-day staying around, but it's generally in a positive position still. But it has lost that. It has lost that near-term momentum. Big tech is really in a consolidation phase. So potentially, like this could be like a zigzag type correction where the market does pull back a bit further. You get that classic zigzag structure. Or it could be like a coiling pattern where we've got this, like you can see the market. I'll just sketch it in, where the market could just continue to sort of like coil before potentially breaking out in the coming weeks. So different ways this could play out, but at this point it does look like it's that developing corrective structure after what has been a strong trending period. So nothing unusual about getting those corrective pauses in the trend. And because this group is such a large weighting in the S&P 500, it does make it hard for the index to move higher when these seven are broadly pulling back. But as you saw with the equal weight, the S&P 500 equal weight, sections of the markets are rising. So let me show you one of the strongest sections in the US market, and that has been industrials. So US industrial stock. This is a State Street industrial sector ETF. So giving you that broad look over the industrials. And so what we've got a strong rally in recent weeks, and that follows a consolidation. It's about I think it's about a 6 month, maybe a 6 month consolidation. Two, and then along the moving averages, and then we've just had a breakout really since at the start of the year, and another push higher in the industrial. So while the S&P 500 looks like not a lot's going on, as you can see, there's quite a bit going on in US stocks. The small caps tell a similar story as well as the micro caps. So it's interesting when you look down through the different areas of the market. This is bullish price action. It's not a sign of, at least I don't think this is a sign of impending trouble. When you just bring it back to the S&P 500, I think the play here, I think it's staying long stocks. That's been our standard position since I think around May last year. I think it's still the case. It's stay long stocks, continue to hold what's working, and use a good exit strategy to sell stocks when they're not working, when they start to break down. But it's keeping winners, running winners, cutting them when they stop working.
Yeah, fantastic, Jace. I like that. Let's have a look at the Hong Kong market then.
Over to the Hang Seng, starting with the Hang Seng. Little change from last week. Not a lot going on in the last few days. Prices are consolidating above the moving averages, and that follows this nice rally we had from the mid-December low. Good strong rally, a pullback, and now it's like pausing above the moving averages. Maybe it just tracks sideways for a couple of weeks, maybe a week or two. But if it does that, that could then set the platform for another rally. So could we see price action like such, and then from there perhaps we get that breakout. I think this sort of upward breakout is I think that's where the odds are favouring at this point. If we look at the price action since early October, you'll see a range is formed, and you can just see it clearly. I can just put it on here. Like there's our range there. So it's really been just moving back and forth within the range. But as I say, if it can now establish above the moving averages, I'd be looking for that break to the top side I think that's what the odds favour over the coming weeks. And just quickly over at China, Chinese stocks, they haven't been as strong. Overall, I think the upward trend remains in place, but it's trading down at the lower end of its recent range. You can see the range in here. I just sketched that in. There, you can see it's just back and forth, but it's sitting at the lower end of that range, whereas the Hang Seng is at the top of the range, so it's more strength than other parts of the Asian orientated markets. I think it's important for this market to really get a foothold around current levels, and then to quickly make its way back above the moving averages. We really don't want a situation where prices start consolidating below moving averages, which start to roll over. So to keep the bullish story firmly intact, I think we need that move back above the averages. But look, I think the potential for this ranging period to resolve to the upside, I think it's still very much open. But it's that case that we need to see buying of the dip emerging, I think, around current levels, and we need to see it emerging soon.
Okay, fantastic. Thanks, Jace. Let's talk a little bit in general now. We were left with a question from one of our viewers last week, and I think it's a good one just to recap. And it's all around the technical indicators that you use. So maybe you can just touch on, the question goes something along the lines of, what is the sweet spot in terms of a number of technical indicators you use when doing purely technical trading, and which are the gold standards that you use?
The sweet spot, it's I think keeping indicators to a minimum is the play. There are lots of indicators which we can use. A lot of them do something similar. So you can use moving averages and then MACDs, but you're kind of doubling up a little bit. It's like I think less is better when you're using indicators. I watch things on YouTube where there's so many lines and indicators on the screen, I don't know where to look. And every time there's a movement in the price, it's hitting another line of some description, and you just wear your signals. You don't know what to do. So keep it simple. Remove all the clutter, and focus on maybe just one or two indicators. My go-to is are the moving averages. Different timeframes for different purposes, but for what I do with Motion Trader and with my own portfolio, the 100 days, I think they're my go-to. And the moving averages are the go-to for a lot of successful traders. They do focus on, and investors as well, they focus on what the moving averages are telling them. And it takes the noise out, and is price above the moving averages or below? It's a simple test of like where the path of least resistance may be. So I think that would be my number one. I also like looking for, we call them breakouts. So it's like the moving averages. So the moving averages might cross, but then I want to see like a break higher to confirm the direction. So I need to like to find a good example. I'm just scanning back through the price action to see whether there's an example I can use. It's like maybe we'll come across it when we're talking about stocks later on, and so like Yeah, like here's an example. So the moving averages cross, but then you project up to where they cross. Price is already starting to pull back. So just because the moving averages cross, it doesn't mean it becomes a buy for me. I like to see the moving averages cross and then confirmed by a new high. So in this case, a new high didn't come until a little bit later on, where I use a 70-day high with the motion trader service. So it's combining a moving average cross with prices moving to a 70-day high. So they're two indicators which I use together. Sometimes I have a look at an RSI, or not that often. Look, I don't think there's any special holy grail indicators which tell you what the market's going to do. It's that's why I just like to keep it simple, Rog. Just really that the moving averages I just keep coming back to as my number one.
Fantastic. Thanks for answering that, Jason. To be honest, I've really taken on to this simple concept, and I used to use probably about 3 or 4 indicators, and I've just taken it back to what you've just said there, Jace, perfectly, and it's working quite well for me. Now, obviously, this is what we use on this show as well, right? There can be a million ways to do it, but this is what we're teaching on the show, right? So if you want to learn about Jason's system, then I recommend you just go over to motiontrade.com.au, and he just gives it to you, everything in videos and guide there, ready for, and it's free, basically, right? So go check that out. Now, I've got the pre-comments here before we go live, Jace. So g'day, Daniel, and hello, David, and we're going to start with, if that's okay, with David's, Daniel's. We're going to look at NVO, please. NVO, if that's okay.
NVO.
Yeah.
Look, it's one of those lower price stocks which.
Is this a US stock, by the way? It says US. I'm just wondering, maybe it's.
It could be. That's the home exchange is probably the Canadian, the Toronto Stock Exchange. It's well, look, it's one of those stocks where if I had it, and it's like there were. Like the moving averages cross, it kind of breaks high. There's, you can see reasons why someone could have bought it early. It's been a harder one to catch, quite frankly. It hasn't been, great chart structure that's really evolved to give us a clear jump on point. But had I jumped onto this one earlier, great, I'd be holding it. But it's a hard one to buy now. It's because, how do you manage your risk from where it currently is back to the moving averages is 43%. So it's like you're kind of then saying, well, if I buy it now, I just put a 20 or 25% stop on and hope for the best. I'd probably rather not do that. So it's not one I'd buy at the moment, but it's one I'd certainly hold. I'd certainly hold it, see if it can hold on to its gains. If it can hold on to these gains, maybe establish another platform at higher levels. Well, then maybe that provides an entry point then. Let these moving averages catch up. Look, we could well get a new entry, but at the moment, it'd be a hold rather than a buy.
All right. Nordisk, NVO Nordisk, is that one there? There's a few different NVOs, obviously. Nordisk, maybe it's that top one right there. That top one.
Yeah. Okay.
Yeah.
Okay. Well, this is an interesting one. So it's gone from a long period below the averages, it's now above, and the averages are starting to turn. So this is setting up a potential entry point. It's probably a touch early for me, although some people will say, "Look, I don't want to miss it, so I just want to buy it now," and that could be okay. It could be maybe it could be bought now with a say like a 25% stop thereabouts, just back below the moving averages, giving it a bit of room. That would be one strategy. Buy it now with a stop. Alternatively, if we were to often we get in these situations, we get the sideways trading while the moving averages then start to turn. And if we got that sideways trading and that platform develop, well, then it could be a case of buying the dip from that consolidation or buying a breakout to a new high, and that's probably the way I'd play it. So the moving average would have crossed by then, and I'd buy the breakout. That would be that's what I was talking about earlier, where I wait for the moving averages to cross, and then I wait for a breakout to confirm it, and the breakout would be a push up to a 70-day high. 70 is not a magic number, but it's just a number which works in my longer term back testing. Could use 80 days, 50 days, 40 days, whatever it may be. But it's like using a new high in the price structure as a confirmation of the moving averages crossing. So that's how I'd be looking to play this one. Well worth keeping an eye on.
All right, fantastic. Good example there of what we just talked about the indicators as well. Let's get on to David's. So it's an ETF, Wire.
Yes, this is a local copper ETF. It's I've got some of this myself. It's Look, I've talked about this quite a bit in my Friday strategy sessions, and it's been a case. What I've been saying in the last for a little bit now, it's holding positions, letting this trend run, see where it goes. We talked about entry points back around August as prices were rallying off the moving averages. But as prices have become stretched above the averages, we did get a bit of a pullback in November and a rally. But at the moment, I find this a harder one to buy when after it's rallied so far, it is pulling a little bit away from the moving averages. So I'm not sure it's the most asymmetric risk reward entry point, but it's certainly one which I'm holding and completely comfortable continuing to hold and see where it goes. Wide stop, back below the moving averages, and giving it that room to move and staying on a rising trend. Copper stocks generally, it's not just a copper ETF. Of course, there's also a range of copper stocks which have been identified through the motion trader signals, which are doing well also. And it's the same strategy, letting what's keep working, and but always manage risk around it. Not just shut your eyes and go away and come back in 2 years and see what's happened, because sometimes the wheels can come off. So you want to have always got to manage risk and be aware of the price structure. But whilst these things are working, I want to let them run, and sometimes they can run a very long way.
All right, fantastic. Thank you. All right, hi Adrian. Let's have a look at your stock, which is TLX. There is a bit of a question behind this, so we'll get you up. I brought TLX at 27, not long before it topped out around 30, but held on for the usual reasons. It's now around 11, showing some promise. I'm tempted to buy in substantially lower, lowering my average cost. What do you think?
Yeah, look, what we've said in the email, unfortunately, I don't think that's the. I always talk. The big things I talk about are we run profits and we cut losses when the situation changes. One of the big mistakes I often see people make is that they don't want to take a relatively early loss, and this is just mentally how humans are hardwired. They've done studies on this. It's like we tend to be quick to take a profit, but we're slow to take a loss, and we don't like taking that loss, and that's how a loss can snowball and get out of control. And we don't like taking losses so much. And another strategy we often like to use is to average down. So we'll buy something that hasn't been working to give us a lower average price, in the hope that the shares only need to rally halfway back and we can get out at evens, or maybe at a small profit. But it's like it tends to be I think that's a difficult approach to take forward for long-term success, because it's all based around buying what's not working. I want to buy what's working. I want to buy a stock like TLX when it starts to move higher, when the moving averages cross and we start to see it breaking higher. This is when I want to play it to the upside. And I'll take an initial position. If I want to add to a winning position, sure, we can consider that and just let it keep working until it stops working and we find it below the moving averages. The moving averages start to cross, starts to consolidate below the averages, and then it starts to break down. It's like, well, this is no longer working. So sometimes a stock can look like it's breaking down and then recover. but it's the ones that don't recover that cause all the damage. So this is why I think the exit strategy is so central to having success in the stock market, because when it's not working, we just walk away, we get out. Look, buying down here now, maybe this is the low, but the question I would ask would be, what if we double up here, and in 6 or 12 months' time, this trend extends lower, and maybe it gives us a couple of little short bursts higher to keep us encouraged, but then we just this is the price action. What if this is where we are in 6 months' time, and we've just done a big double up at $11? So what will we do? What will we do if that happens? Do we buy some more, or do we then say, look, it's now too hot, I've got to cut? But the way a lot of people are wired, they'll say, look, I better buy some more, or they'll just keep holding and for the day that one day it recovers, and it may well do, and one day it may hit new highs, and we're rewarded for gritting in. But sometimes these stocks go to zero as well, and we don't know which ones are the ones which are going to recover, which ones are going to go to zero, until we look back with long hindsight at the end. So yeah, that's how I'd play it. I'd be very wary of doubling up in something that's not working.
Okay. All right. Thanks for that, Jace. I hope that
It's
helps.
a long way around that, Rog, but it's such an important concept, and it's why I think so many people struggle with their portfolios, because they hold and hold and hold and buy more of what's not working. We've got to flip our mindset to holding what's not working to holding what is working and getting out of what's not working. And it's that flip which is so hard for so many people to do, but I think that's the key to having that long-term success.
Yeah, I totally agree. Actually, it just reminds me of, this is the continuation of around about an hour and 25 minutes, I reckon, of last week's show. And it was all about that what if question, right? So if you missed that part, just skip to 1 hour and 25 roughly. And we talk all about the what ifs, if the right what if you should be asking yourself when you see yourself in these positions with stocks, right? So I hope that helped, Adrian. Hi, Devender. Once Jace is back.
Just give me a sec, Rog, because I forgot to plug the laptop in.
No, that's okay.
And that was just to ensure that I don't disappear abruptly.
Well, I did the same before, but I did it a little bit more inconspicuously. All right, so we got it. It's I do the same thing myself. Sometimes I just forget, don't you? Rio, please. Let's have a look at Rio.
Okay. Yeah, well, look, it's doing well, isn't it? And it looks like that materials index, which we looked at earlier, and this is something we've talked about in earlier or later last year, as prices were above the moving average and started breaking higher. We talked about Rio looking promising, and we've seen it deliver. I've got some Rio. I've had it for a while. I'm happy to continue holding, letting it run, and in terms of adding to it, it's not like I prefer to add after like a consolidation. You can see this consolidation from during November where prices got above the averages and they made their way back to the averages. Then they broke higher again. That's sort of like the entry points I like. Had a continued run, has come back to the averages and rallied, but does it? Is there another trip back to the averages and a larger consolidation then up? Like, I don't know. It may not do that at all, but often the first move back to the averages, there's a like a secondary test, as we saw in this example here. It came back, it rallied, then it came back again. So I'd whilst it's below the high and whilst it's in this range, I'd probably watch if I was thinking about buying and just see how this price action develops. But I'd very much be holding if I was already in.
All right, fantastic. Hi, I love your username. Great Bulls of Fire. How are you? And g'day, Bob. Let's have a look at Astros, though. Hello, FMG, please.
Yeah, look, I've got some of these, and trends up. It hasn't been as strong as the materials index or Rio, But look, trend here is up. We've got the rising moving averages and prices above those averages. I'd be happy to continue holding it. If I was thinking about buying it, I'd probably just wait and see whether we get the like it could be buy the dip. Buy the dip here is one strategy, or it could just be just wait and see whether we just get that break higher. So just waiting for the rebound and the break above the previous highs, just out of confirmation that the trend remains intact. It's just a timing preference, how I generally tend to do it. Also, this was like a sharper pullback here. If it was just more like more coiling, I'd be more inclined to buy the dip. But just because it's been a sharp dip back to the averages, I'd probably be inclined just to wait and see what happens here. Does that sharp sell-off quickly get bought and push prices back up, or does something else start to happen? But yeah, I'm there. I'm happy to stay there. Trend is up in Fortescue.
All right, thank you. Hi, Dennis. Let's have a look at CBE.
Trends up. I'd be holding if I was in. It's one of these low price ones. Lots of these low price ones have been running in recent times because it just shows that the strength we're seeing and the enthusiasm we're seeing in the mining sector when all these 3 and 5 and whatever cent stocks start performing. But the thing to remember is that a lot of them also then return to where they started. They don't all become the next Fortescue or the like. This stage, look, I'd be hanging in there. It's hard. It's a harder one to buy because, again, like we talked about one earlier on, it's like, where do you put your stop? You kind of like, it's like you kind of really need that high 20% to 40% sort of stop on it, buying it here. Otherwise, you're picking a number and hoping it doesn't get hit. So it did give a reasonable entry too. Like there's the moving averages cross. Prices are breaking up. So had we gone with that early momentum, it was a reasonable, very reasonable to say, look, there's an entry point there. If we're in at a good level, I think it's a case of staying with it, see whether this trend can develop into something larger. But I'd be hesitant to try and just jump on board because I just think the risk is harder to manage. It's not to say I don't think it can go higher. I think it can, but how do we manage risk? That's a question things always come back to. It's great to have an opportunity we like, but can we effectively manage our risk? I don't want a group of stocks which could potentially leave me exposed to 40, 50% losses. It gets a bit harder when that happens.
Yeah. All right. Thank you. Hi, Lisa. Let's have a look at EGR, please.
Look, had been doing well, but the structure's not great at the moment. It's consolidating below these averages, which are turning lower. I'd probably would have been like, had I been in at lower levels or even at higher levels, this pullback is probably enough to have taken me out. Like that's a 53% fall. Even with a wide trailing stop, I think my stop would have triggered on this one. I'd probably be out of it, and I wouldn't be buying it at this point because it is below these moving averages. I need to see it get back above the moving averages and then become established above the moving averages and then start to break higher again for it to then, before I could start considering it as another possibility. At the moment, I'd probably just be inclined to stand aside from this one. If I was still holding it, I'd be thinking, okay, look, where am I going to cut this one and move on? I'd probably use these. We've got some clear-cut lows to use. So I'd probably say, look, a break below, just to break below that recent low. So if it trades down at say 30, 31 cents, 31 cents thereabouts, I'd be saying, look, it's not working out. I need to move this one on and protect capital, do something else. If it can hold that level and get back above the averages, well then great. We can reconsider it. But I'd be careful with this one, and I'd want to know what my exit strategy was in case it breaks down again. Because I don't want to be hanging on if it's down at 20 and then 16 and 12 and so on. It's it goes into a long downtrend. That's always possible. That's what we're trying to avoid getting stuck with. Like we saw with TLX earlier on, we don't want to get stuck with something that continues to deteriorate. So think about that exit strategy now in case it breaks down further.
All right, thank you. G'day, Aka. Let's have a look at MTM, please.
Yeah, and this is kind of what I was meaning with our last stock we just looked at, like below the moving averages, needs to get back above and establish back above the averages, and then start to break higher, which is now starting to do. If I was in this one, I could stay in there at the moment. Although if I'd been holding from earlier levels, I think this would have been big enough. That probably would have hit my trailing stop. Although I'm not sure. I'd need to do some calculations. But look, if I was in there now, I'd be giving it the benefit of the doubt to the upside because it's gone from below to above the averages. It's really established itself again. It's starting to push higher. In terms of buying, I guess if I like this stock, if I particularly like this one for some reason, probably could be considered at current levels with probably needs a 26% stop, just gets it back below those recent lows, back below the moving averages. Nothing to say that it can't come back down there and just continue within a range. But look, I think there probably is an entry opportunity at current levels. A stop below the recent lows and see whether it continues to lift after that large correction that it's had. But yeah, it's an interesting one with, I think, upside potential.
All right, fantastic. Hi, Roberto. Let's have a look at MBK, please.
NBK?
M for Mary?
M. Yeah, look, there's an emerging trend here. It's like a 2.8 cent stock. So these lower ones, as I always say, they have a history of disappointing, but some of them can really deliver. So if you like these things, it's a structure which certainly can be considered because it's stepping higher. So it's gone from below the averages to above, consolidated back to the averages, had a rally, pull back to the averages, another strong rally, modest pullback. So at the moment, it's a shallow pullback. Looks like maybe the dip's being bought. It's there's nothing to say this can't really continue to move upward. So there's asymmetric upside because the risk can probably be managed. To say it was bought at current levels, like it's maybe a 25% stop. It's getting it back below the 50-day moving average. I think it's certainly speculative, but but there's a possible play there. Could be bought at current levels, 25% stop. See if this stepping pattern continues to develop and we get like a big push higher. The difficulty with waiting for a break to a new high is that it just probably gets harder to. Risk just starts getting a little bit harder to manage because you probably then maybe need a 30% stop. So harder one, but there's some structure developing which is interesting and I think prospective.
Okay, thank you. Hi, Angela. Let's have a look at ELD.
It's just consolidating at the moment. We don't have that near-term momentum. I'd leave it at the moment. Like if I had it, I could keep. If I was holding it, I could keep holding it. I could probably have a stop below these recent these lows. Like we could use the November low at around $6.60. So break below the November low, down to like $6.50 or something like that, and then the moving averages have turned lower. Prices are making new lows, lower highs, lower lows. That would probably be an exit point if I was in it. If I wasn't in it, I'd be watching for a breakout. So it's oscillating either side of the moving averages, and the moving averages are seesawing a bit too. But if it can break higher, if it can say clear the maybe the mid-October high, which would also include the November high, if it could clear this region, if you could clear that region, then it's like broken a series of lower lows, and maybe that could be an entry point then, and maybe that could be done with a relatively close stop, maybe even just a 10% stop. We probably need to see some more price action develop, but that's how I'd be doing at the moment. If I wasn't in it, I'd just be watching it. If I was in it, and I'm watching it for like a break higher, but see what price action develops. If I'm in it, I'm probably out below 660.
All right, thank you. Let's have a look at the next one, which is Mix SVL, please.
Yeah, well, not surprisingly, Silver Mines is doing well in the current environment. It's certainly one I'd be holding if I had it. Looking at where it is now, it's up near its highs. Like the difficulty with buying into silver at this point is that the trend in the silver price is just so extended historically. We could say, look, buy it. It could be bought at current levels and put a 25% stop on just below the 50-day moving average and just below this recent consolidation. So there's a case certainly a case I think could be made to buying it. And seeing what happens. My understanding is there could be a fair bit of leverage to the silver price with this, although it hasn't really gone up in multiples so far. So I don't know. You'd have to check the fundamentals out. But look, there is a case for buying at current levels, 25% stop on it. But just bear in mind that the silver price is incredibly stretched above its moving averages. And I don't know how much higher it can go, but at some point gravity always wins and things come back to the moving averages. Just where that happens to be, we don't know. So it's a volatile sector at this point. So I think some caution is probably warranted if thinking about new positions in silver stocks. But if I had it, look, I'd continue holding it.
All right, thank you. Next one is from Alexandra, please. Can we have a look at, sorry, I've lost my MTO, please. MTO.
Yeah, it's just look, the averages have crossed to the downside. Price has been consolidating below the averages, and price is close to making a new low. It was a motion trader stock. It had done quite well, where the initial entry might have been somewhere around November 24. So you can see what I was saying earlier. So the moving averages cross, but the price isn't making a new high. So just moving averages crossing doesn't draw me in. Because sometimes it doesn't make a new high and it continues lower. So waiting for that upward confirmation can help avoid some unnecessary entries. But this one did provide a new high, so we've got an entry point. It's done fairly well. But look, I think I'm pretty sure this one hit a motion trader trailing stop last week. And looking at the structure, it's not a structure I'd be buying. Look, it could turn out that this is just like a big sideways consolidation, and in the fullness of time, we see that it does stabilize and then start to move higher. And sometimes you do get stopped out at the low point, but we only know that in hindsight. My concern is that we get a hit to the downside, and we get a trend develops. That's the risk. That's what I worry about. I don't worry about missing out on the rebound. I worry about getting stuck in the downdraft. So I've actually got some of these, and I'll be moving them. I'll be moving them on. If it's if I'm right on it triggering its stop loss, I don't want to stick into a situation which isn't currently working, and the bad stuff tends to happen below the moving averages. So there is vulnerability in the way this is currently structured.
All right, thank you. G'day, Tomo. Let's have a look at when gold and silver, especially EVN. We'll just start with EVN. EV, V for Valerie.
Evolution. Yep. So this has been trending higher. It's case of go with the trend. I've got a position in this. I've had this position for a very long time, and so it's part of it. It's probably like, I describe it as a core holding within my portfolio. And I'm continuing to let it run. It's a motion trader stock. It's been a motion trader stock for a long time as well. The motion trader entry may have been around August 24. Perhaps, maybe it got stopped there, maybe it got back in. I'm not sure, but it's look, the trend in this is up at the moment. I'd be letting it run. Wide trailing stop back below the 100-day moving average. See where it goes. In terms of buying, like I said with silver, gold's also extended. I'm just apprehensive to do a whole lot of buying of gold and silver stocks at this point. I want to keep what I've got and let them run. Consider rebalancing if I've got some which are crazily super extended, or excessive profit growth. But in general, I want to maintain exposure to the trend, but I don't want to keep adding to it. It's at some point we do get a larger correction. We don't know when that's going to be, but it's we don't want to get overconfident after a strong period of gains. That can lead to trouble when things do pull back. So letting positions run. This looks great still, but I'd just be hesitant to keep adding to it.
All right, thank you. Let's have a look at Rob's question here. Actually, a bit of a general one. Is it a good time to start investing in miners? They seem to be very stretched on the basis of XMJ, which you just discussed. And I guess this goes hand in hand with, like, in your motion trader service, Jace, excludes some of the overstretched stocks, or that does not make any difference.
Well, trends can last for a long time and run for a lot further than anyone imagines. We just don't know which ones are the ones that are going to be extend a long way. If I get the right signal in a mining stock, like I added some mining stocks to my portfolio last week. So yes, I think mining is an area to continue looking for opportunities in. That it's a sector that's working. We're getting signals in it still, but I'd look at each signal on its merits and ask, is this stock excessively extended above its moving averages? In which case, maybe I'll let that one go. Or is it just breaking higher after a period of consolidation? In which case, I'm more interested. So, like with the materials index, as I was saying, I would have been more interested in early December after a consolidation and a breakout than coming in and buying it at its new high. So, and that's because just risk is just easier to manage. I find when you're buying a breakout and an early rally off a moving average, you can have a stop relatively closer. Once something starts running, you've got to have your stop further back to give yourself, I think, the best chance of staying on board. That's the thing I'm wary of with buying stocks which are up a significant amount in a short space of time. You've got to be able to work out, like, how do I manage risk during a pullback? But generally, yes, I think mining is a great area to continue to focus on, look for opportunities, but being patient, waiting for the right one. I don't think it's a case of just deciding on one day, yep, I like mining, and just piling in to anything. As it always is, wait for the right setups and the setups where you can manage your risk.
All right, thank you, Jace. Let's have a look at High Sydney 360, please.
We looked at this last week, and we looked at it on this, or maybe it was on my strategy session. I looked at it must have been the strategy session on Friday. We looked at it, and it just gapped higher to the moving averages. And I said, look, I'd rather just leave this alone, even though it's gapped higher in a day. it could just be a case of a quick return to the declining moving averages, and then a sell off again. It's I'd just be leaving this alone for the moment. It's we've talked about stocks in decline earlier. I don't want to buy what's not working, and one gap higher to still being below declining moving averages isn't a sign of a stock that suddenly started to work. For this to work for me, it's got to get back above the moving averages, establish above the moving averages, and the averages have to start to turn higher. That's going to take more than a couple of days. So I'd be inclined just to leave 360 alone for the time being.
All right, thank you. Let's have a look at the next one. I believe Zoe, so PLS. And if the lithium rebound from 2024 lows looking to be optimistic.
So what was that last part, Rog?
Oh, that's all right. It's not a question. It's more of a statement. That's all good.
Okay, continues to trend higher. I'd be letting it run if I had it. I've got some LTR, some Liontown, which is a similar grouping. So I'm letting that run. I'd be letting this one. I don't have this one, unfortunately. I had it, but I got stopped out during an earlier pullback. Got stopped out near the low, which was frustrating. But these things happen. If I still had it, I'd continue holding it. Trends up. It's look, these previous highs look like they're within sight. Would I consider buying it? That's another question. Kind of the stuff we've just been through. It has run a bit. It hasn't been back to the averages for a while. I'm probably less enthusiastic about a new position, but I would be enthusiastic about continuing to maintain a position, which I had at lower levels, and just use that wide trailing stop to stay on board, see where it goes.
All right, fantastic. Hi, MJ Gill. Selfwealth does offer electronic chest statements. So just jump on the help center and then just type in chest statements, and you should be able to find the ability to be able to turn on those electronically. Hi, Wish. Let's have a look at LDX, please.
Was that LVX?
LD for Derek and X.
Well, I'd be holding for now. Is this like we never know what's a pullback and what's a top until we look back later on. So this could simply be a pullback to the moving averages and a touch below, or it could be something larger. So I think the best we can do is to work out, okay, where do we want to set our trailing stop? So I'd be using an ATR based calculated stop. But it probably just looking at it roughly, I'd probably be having a stop somewhere around 17 cents. It's probably how far below. It's giving back a lot, but that's just the nature of this stock. It's gone from 4 cents to 33 cents. So it's going to just the width of the trading ranges. It's going to give a wide stop. That's been how we've been able to stay on. Well, I'm not on it, but that's how you can potentially stay on a stock like this. Like there's a 42% pullback. So the stops are wide, but they can help stay on the trend. If you're using a 20% stop, you're constantly being stopped out every time this thing almost breathes. So look, I'd be holding at the moment. I'd work out where I've got to rule off on it. Wouldn't be buying at this point. Really need to see that rebound, get it back above the moving averages, re-establish above the averages, and then we get the situation where maybe we've got a trading range, or we've got a clear consolidation. We can get a break higher again, but we've got to see how this one develops and have a line in the sand where we can say, look, enough's enough. I can't give it any more room because I don't want to ride it all the way back down to 4 cents, which does happen in these lower price stocks particularly. Yes, that line of the sand here I think is important. I think I could give it the benefit of the doubt now if I was in, particularly from lower levels. But I'd be thinking of where I bail now rather than potentially letting the situation get worse and worse and worse, and then come back and go, well, now I'm down a lot. Now what should I do? So think about the exit strategy now, but I'd also give it the benefit of the doubt in the near term.
All right, thank you. Hi, Chris. Let's look at CMM. M for Mary. Yep.
Yeah, uptrend, new highs last week, moving averages, everything's good here. I'd be letting it continue to run. It's also broken out of a bit of a consolidation. Just roughly we can draw something in like that. Sort of like a bit of a what we'd call an ascending triangle. So the top looks, it's not precise, but the top's fairly flat, and then you got the higher lows. So you call that an ascending triangle. It's broken to the upside, which is what the textbook theory says. Ascending triangles typically break to the upside because the buyers become more and more impatient and keep pushing the price until it breaks. So look, it's a stock which has run a long way. So from that perspective, I always get a little bit more, get a little bit hesitant. But technically, there is an uptrend. The moving averages are rising. It's broken out of a consolidation. It probably could be bought at current levels. It probably could be done on a like 10 to 15% stop thereabouts, and if it comes back down, we get a false break and stopped out. Well, maybe it's done its dash for the time being, but it could also saying that the path of least resistance in this has been and still is up, so it could continue to go. It's not a stock which I'm drawn to and thinking, oh, look, I better go and buy some of these this afternoon. I won't. But if I had some, I'd 100% be continuing to hold. And if somebody really wanted to get some, well, we can build a case and a risk management plan around getting in at current levels.
All right, thank you. We'll go through four more here, just before I put the line in the sand there. So, let's have a look at Remus's MSB, please. MSB.
Oh, sorry, what was that, Rog? MSD?
MSB.
MSB. This is such a hard stock to make money in. It just gaps everywhere. Like you get gaps to the upside, gaps to the downside gap, upside gap. It's it's all clinical trials and all sorts of things. It's I find this one where I don't think there's really been a great profitable uptrend. At least not for a long time, which has been catchable. Like you look, there's big move from $1.20 to $5, but look at the path it takes. It goes up, it comes all the way back down, storms higher. Part of that is like just gapping, so it's hard to get in. It's a hard stock. Well, it has been. Doesn't mean there can't be something in it though. If I was holding it at the moment, well, we have a series of rising lows. That's positive. I'd probably be looking like if it started to break down below these recent lows, get back below these moving averages, back down around $2. I might be looking to move it on. But I was in it at the moment. I could continue to stay there. If I was looking to buy it, I'd probably like to see it, rally off the moving averages, maybe seeing it get back up towards 3, at least going with a bit of momentum, and then having a stop back down below the recent low. Maybe that's how I'd play it. But it's not a stock which I'm especially excited about because of the reasons I went through. Look, if we get some upward momentum, maybe that would be buy into that momentum. Let's see if we can get that rebound off the moving averages first, and it's not just coming back to the averages and then starts to dip below it. One to be careful of, I think.
Thank you. Hi, Dan. Let's look at A4N.
Hasn't been anything here for a while. but it's moving back into the sites of potential. So it's gone from below the averages to above, and the averages are crossing. So we have seen this before, below to above averages are crossing, but it didn't really hold on to its gains and oscillated back to the other side of the averages. What I'd want to see is I want to see it hold these gains. So I want to see it like start to just get that sideways trading above the moving averages, and the moving averages start to turn higher. That's when we get sort of like the strong rally, the shallow pullback. We can start to say, well, look, okay, it looks like there's buying interest which is underpinning it, and then my typical play would be buy the break higher, and then have a stop not too far away maybe, and see whether it can gain some momentum from there. So it's moving into position. I don't think it's quite there yet. One to continue watching. Yeah. The key is establishing above the moving averages. So then, like you can see, it hasn't been able to do that in some of these previous occasions. Hasn't been able to establish above the averages, and as such has been stuck within this large range. So that's the key over the next few weeks. An interesting one to come back and revisit.
Another great example of how the patience required for the indicators that we use, right, to get into positions, right? So the next one's from Jefferson, APA.
Is that AB?
AP for Peter and A.
APA. It had been trending nicely. I'd say this is still on an uptrend. If I had this one, I'd continue holding it. If I got in at these earlier points where the first signal for this would have been. Look, it's had a pullback below the moving averages, but that will happen. It's only been 10%. It's I'd be holding this. It may need some more time. Maybe it just we get that sideways movement for a few months, and then maybe it can resolve higher later in the year. All sorts of ways it could play out, but it doesn't have near term momentum. It looks more corrective at the moment. There's you got that zigzag decline, but there could be more in it. I'd be inclined to. So if I had it, I'd probably keep. I would continue holding it because it wouldn't have triggered my stop loss. And if I was looking at buying it, well, I'd probably just be patient and just watch how this corrective phase develops, and see if we get a good entry point at some time in the weeks or months ahead.
Thank you. Last one, Magma, GHHF.
Was that GHAF?
Double H, GHHF.
Better wealth, build a diversified, all growth geared. Well, I'm not really sure what they do. Look, the trend in this is up, so it looks a bit like an all world shares index or something. And look, it continues to trend higher. It's holding the moving averages. It's I'd be happy continuing to hold it. It's 23. You just got to be careful with geared investments when there's big pullbacks. I was just curious what that pullback was, but it's only 23%. I think that was kind of in line with what the market may have done. So it looks fine to me. I'd continue holding it. The question is, do you buy it as it consolidates on the moving averages? Possibly. If somebody liked this and wanted to get on board, this could be an entry point, or alternatively a break above the like you can see it's sort of like we've got a bit of a compression or a contracting range. So yeah, a break above the January high could also be an entry point. So you're buying into the momentum perhaps. Yeah, but it's one to, I think, maintain exposure, maybe consider exposure if you like it.
All right, fantastic. We might finish up on there, Jace, but we will get on to just one quick general question. And there's another great question on there, which I'm going to wait till next week to answer. I'm sorry, Tony. But you've got a good response there from Kirby as well, I see. But let's have a look at this 50 and 100-day moving average again. Why do you choose those time frames, let's say, over a 30-day moving average?
I like the 50 in that it's fairly responsive, but not too reactive. So if you use, say, a 10 and 20, you're going to get a lot more crossovers, and that can be fine. There's nothing wrong with that. You're just going to get more signals. You got to wade through and consider. So the 50 and 100 work well. But look, I could use 40 and 80, and it's going to give a broadly similar outcome to using 50 and 100. So they're not magic numbers. I'm just using big round numbers basically. We could use 45 and 102. It's like it's going to do kind of the same thing. There's nothing wrong with shortening your moving averages, but just understand that you're going to naturally get more signals. So when I've done the back testing, I've back tested with data going back to the early 1990s, so thousands of different stocks, and I've used all sorts of different moving average combinations, and I've just gone with a combination which works well either side. So I can go a bit longer. I could use 60 and 120, or 70 and 140, or I can come the other way and shorten it. 50 and 100 sits in the middle somewhere. I haven't like just picked the like it's called curve fitting, where you look for you do all the tests and you find the best possible combination. So it might have been 49 and 103. It's like, but is that a robust combination? You want to see your whatever you're using working well a bit either side. And look, so I've gone with 150, and it's like, even if I was looking at an hourly chart, like 50 and 100 hours, it's I like it because it's just not too reactive and crisscrossing every or too often to give too many signals. But look, test all sorts of things, consider all sorts of things. There's no magic combination that works best all the time for everything. It's there are going to be times where people say the 1500 are too slow. And for instance, after a market sell-off, the 50 and the 100, they're slow to turn around and cross when it's like a V-shaped recovery. So that's one of the downsides to the slower moving averages. But other times being slower moving is better. So nothing's going to give you the perfect lineup, and you may need to be flexible with your thinking sometimes. But consider what's going to work for the approach that you want to apply.
All right. Thanks for that, Jace. I think we've taken up enough of your time for today. Much appreciated, everyone coming along. There is a great question around, matching some fundamental data along with the trend for next week, which we'll touch on. So to be continued, and I'm going to leave everyone on suspense so you can come back and watch next week's show, I hope. Don't forget to like and subscribe down below. Leave us a comment if you'd like. It'd be great to hear. We love you coming along. We love you coming along with all your tickers as well. Sorry we couldn't have more time, but yeah, we've obviously got to respect your time as well. So I hope you have a great week, and thanks, Jason. Thanks a lot for your time.
Yeah, thanks, Rog. Thanks, everyone, for coming and joining us. It's been fun going through all your stocks and having a think about things and looking at the markets, and hopefully it's been helpful. And as Rog says, we'll be back next week and look forward to it.
Back next week, everyone. Thank you very much, and have a